You think investing is about picking better assets. It is not. Rich people often win because they are allowed to see a completely different menu before the public ever gets invited into the room. Today, you will learn why the financial system changes as wealth grows, and how to stop playing a game you were never structurally prepared for. This is for the retail investor who follows the rules, contributes to retirement accounts, buys index funds, and still wonders why the wealth gap keeps stretching further away. We will break down the hidden access tiers inside the US financial system, why larger capital changes the math of risk completely, and the exact traps average investors fall into when trying to imitate millionaire behavior too early. Most people miss that the menu itself is gated by design. Trying to force your way through the gate before you have stability is exactly how people destroy their financial foundation. Once you understand this structure, you stop chasing shortcuts and start building real leverage. The average American investor operates almost entirely inside a public sandbox. You open a brokerage account, a 401k, a Roth IRA, or a retirement plan. You buy index funds, ETFs, mutual funds, and publicly traded stocks. This is the standard menu. It is liquid, regulated, and transparent. Everyone sees the same ticker at the same time. There is nothing wrong with this system. For most people, it is more than enough to build long-term wealth if they remain consistent. But you need to understand one uncomfortable truth. Public markets are usually the final stage of the wealth pipeline, not the beginning. By the time a company reaches major exchanges, early investors have already captured the largest growth phase privately. Venture capital, angel investors, and private equity were involved years earlier. The average investor sees the polished version after the biggest asymmetrical upside has already been absorbed. The system is not broken, it is layered. As wealth increases, the financial system unlocks new categories of access. One of the clearest dividing lines is the accredited investor threshold. Typically, this means earning over $200,000 annually, or having a net worth above $1 million, excluding your home. Once someone crosses that line, the menu changes immediately. Entire categories of investments become available that most people never even see. Now, access expands into private equity, venture capital, hedge funds, private credit, real estate syndications, and startup allocations. These opportunities are not listed on standard apps. They are relationship-based, network-driven, and often invitation-only. This is not a conspiracy. It is a regulatory system built on the assumption that wealthier investors can absorb more complex risks and survive larger losses without collapsing financially. The result is a completely different investment ecosystem. Wealthy investors often see opportunities before they become retail products. Retail investors see them after packaging, marketing, and fees have already been added. Most people hear this and assume the solution is gaining access. That assumption is exactly where they go wrong. The real advantage is not just access. It is what supports that access underneath. If you have $50,000 invested, losing $10,000 hurts deeply. That is months or years of labor disappearing. It delays goals and creates stress. But if an institution controls $50 million, that same loss is irrelevant. Their lifestyle does not change. Their timeline does not change. Scale transforms the emotional meaning of risk. This is why wealthy investors tolerate volatility differently. Wealthy investors can survive longer holding periods, failed deals, illiquidity, and market cycles without panic. The average investor often cannot. That is why copying wealthy allocations without wealthy stability becomes dangerous. The structure underneath the investments matters more than the investments themselves. Strategy without stability becomes fragility. Liquidity is one of the most powerful financial advantages. It means you can convert assets into cash quickly without destroying value. The average household depends on liquidity constantly. Emergencies happen, expenses spike, and income can change suddenly. In these moments, liquid capital becomes survival oxygen. This is why public investments matter. They provide access, flexibility, and control. Wealthy investors do not need that same flexibility. They can lock money into private funds for years because their survival does not depend on it. Illiquidity changes patience. It can even protect investors from emotional decisions. Without constant price updates, there is no panic button. Forced patience often leads to better long-term outcomes. The average investor believes constant access creates safety. In reality, constant access often creates emotional instability. Watching markets move every second leads to stress, panic selling, and poor decisions. Meanwhile, private investments remove that pressure entirely. The difference is not intelligence. It is structural design. Wealthy families do not just buy assets, they build structures. Trusts, legal entities, insurance layers, and tax frameworks isolate risk. If one investment fails, the damage is contained. For average investors, one bad decision can affect everything at once, from housing stability to future savings. This structural protection creates resilience. The biggest mistake average investors make is imitation. They see billionaires investing in startups, influencers discussing private deals, and suddenly index investing feels boring. This leads to copying visible strategies while ignoring invisible foundations. That is where people sabotage themselves. You are adopting billionaire-level risk with middle-class fragility. That combination is dangerous. If wealthy investors lose money, life continues normally. If average investors lock money into illiquid speculative deals and they fail, their financial system cracks. Sequence matters more than sophistication. Wealth is not built by sounding advanced. It is built by surviving long enough for compounding to work. Stability must come first. Complexity comes later. This is the foundation most people ignore while chasing advanced strategies too early. Access only matters after stability exists. Do not chase exclusive investments until your financial system is stable. Audit your emergency fund. If you cannot cover 6 months of expenses, you should not be investing in private deals or speculative opportunities. Build survival first, then build complexity. Liquidity is financial oxygen. Your liquidity must match your fragility. Calculate how much of your portfolio can become cash within 3 days. If most of your money is locked away, you are not powerful. You are trapped. Private does not mean better. Apply more skepticism to private deals than public ones. Evaluate fees, risks, and transparency carefully. Less visibility does not mean more opportunity. Often, it means hidden risk. Match complexity to your capital size. If your financial cushion is small, your system should remain simple. If you cannot explain an investment clearly, it may be too complex. Complexity creates the illusion of progress while increasing risk. Behavior compounds harder than products. Constantly switching investments creates friction, taxes, and stress. Automate your investing. Consistency beats cleverness. Reduce emotional decisions and let time do the work. Wealthy investors do not succeed because of secret investments. They succeed because they mastered behavior first, saving consistently, controlling expenses, staying invested, and avoiding major mistakes. Access comes after stability, not before. What matters more? Better returns, better access, or better behavior? Wealth is not just about returns, it is about flexibility, stability, and time. The people who gain access to better opportunities are usually the ones who mastered the fundamentals everyone else tried to skip.